How do you price risk right now?
Well, you have to take into account a lot of the uncertainties in the marketplace. Clearly, we have to deal with the geopolitical risk. We have to deal with the trade policy risks that are coming forward. We have to deal with the potential for fiscal policy changing over the next cyclical horizon. And as a result, as investors, we have to prepare for that volatility by finding ways that present better risk returns, de-risk portfolios, and at the same time create optionality. Put safe capital away for the future, maybe the next year or two, and then as those opportunities present themselves, be able to create liquidity and roll into those new opportunities over the next few years.
Sounds perfect.
Ideal, right?
Yeah.
So,
what is it?
So basically, in order to do that, you have to take advantage of what's going on in the front end markets, which is very high short end rates right now. We've been talking about the flattening of the yield curve for the better part of a year now, but what that's really doing is creating an opportunity set within the front end of the yield curve. You have 2-year rates right now about 2.6%, and obviously another auction coming forth today. That actually is creating a lot of good opportunities for investors to preserve capital, earn some income along the way, and at the same time reduce the volatility to the overall uncertainty in the marketplace. And that's sort of an ideal place to be, at least for the next 6 to 12 months in the marketplace.
How much of it is the yield that you get, and how much of it is just optionality? Because if you're in short term, then you really aren't frozen in, and you can respond to developments in the marketplace you can't anticipate right now.
Correct. Well, ultimately what we're positing is that by taking advantage of the opportunity sets, not just in treasuries, but across the entire fixed income spectrum, including corporates, structured products, things like that, you're able to create a diversified portfolio which offers not only differing and diversified sets of income, but also diversified sets of liquidity. So when those opportunities present themselves over periods of time, you're able to shift to those risk allocations. But with all the uncertainty in the marketplace, generally, you don't necessarily need to be taking a lot of risk to earn 2.5% to 3% in short-term bond funds. You can do that, and at the same time, really taking a reduced interest rate exposure. So you can do it by taking a year or less of interest rate exposure, as opposed to reaching out the curve, taking a lot of credit risk or taking a lot of interest rate exposure, or more importantly, going wholeheartedly into higher risk situations such as equities.